Hello, hello, ladies. This is the first video that I am actually doing for the alumni class, and we're going to be talking about managing your finances and becoming financially literate. So I am going to share my screen, and we're going to go and get started. Okay, mastering your money. We're going to be talking about a roadmap to financial freedom. It is so important for us to be good managers or stewards over the money that we have because God cannot give us more money if we're not managing what He has get stewarded us well. So in this presentation, we're going to be talking about your personal finances, understanding the importance of budgeting, investing and savings accounts, managing debt and credit, and planning for your future retirement. You know what? If we do not manage our money well, we end up in a financial crisis. We're living paycheck to paycheck, stressed out. How are we going to pay this? How are we going to do this? But if you're not budgeting, guess what? You have no idea where your money's going, nor ways that you can actually begin to save your finances. So what is income, expenses, assets, liabilities? Let's just define those. Income is any money coming into your household, whether it's alimony, child support, investment, work, or any other source. If it's coming in the house, it is considered income. Expenses are anything going out of the house. Bills, services, going to get your nails done, getting a pedicure, all of those, your rent, house note, those are all considered expenses. What are assets? Assets are things that you own, like property, money in a savings account or investment or CD. Those are considered assets. And I want to stress here, a car is not an asset. A car falls under the liability category. Once you purchase a car and drive it off the lot, it starts to depreciate. Unlike property that you might own uh, money for, it is actually gaining more money because it is growing for you, but not a car. So when you're purchasing a car, take that into account. So let's define some financial goals. And we talked about this last month. We were talking about financial goals and setting goals, and we even went over budgeting and the importance of budgeting. If you want to, a lot of times it's great to have some financial goals. Say you want to go on a vacation, it might be a good idea to save X amount of money so that you can go on that vacation. It's planned for, and the money is actually put away for that, and you're not charging it on a credit card. I would encourage you to stop using credit card for vacations, especially if you can't afford it. That's why it's important to budget because when budgeting, you can look at what you have and make some sound decisions. And short-term goals, it could be saving for a house. We say, so a lot of people say, well, I want a house. Well, you have to have some money down to put on a house. I know you can get first time home buyers, but you still need to have 5% to go down on a house. So saving for a house, putting a little bit aside for vacation, all of those can be great ways to actually begin to manage your money more effectively. And then long term is looking at retirement. How much money, if I retire in 10 years, how much money do I have put aside that I can actually retire on? The importance of financial literacy. When we understand money and how money works, it actually gives us the ability to make wise money management decisions. We make good money decisions. If I don't have money, then maybe I shouldn't go to the mall looking for a new outfit I can't afford. Just stay home. Or take out the credit card. You're just looking. So come up with some little practical things that you can do to help you manage your money. And having financial literacy also helps you understand debt pitfalls like credit card debt. Credit cards can work for you or credit cards can work against you. Now, I have credit cards, but, and I have two major credit cards. And those credit cards get paid off every month. Why? Because I'm not paying interest. One of them is a Delta American Express, and it gives me miles. So most of my trips to see my daughter are paid for because I use my mileage from my Delta card. And that's one of the ways I use the credit card to benefit me. And then I have a American Express because a lot of people don't take the other credit card. All of those credit cards get paid off every month. I do not pay interest on credit cards because most of the interest on a credit card is like 24% interest. And if all you're paying is minimum on it, you can be paying for that charge for 30 years because you pay the interest and then they ask more interest to your account. So just be aware those credit cards are a pitfall for getting you in debt, and it can be very, very detrimental to your credit scores if you're not paying them off early. When you have good financial knowledge, it allows you to make long-term, healthy future decisions. So budgeting fundamentals help you see where is my money going? Is most of my money going for life, housing, transportation, debt repayment, savings? Where is my money going? Well, budgeting can help you find that out, where your money's going. So, creating and maintaining a budget is very important. It gives you a list of all the sources of your income each month. It helps you categorize where your money's going. Is it essential? Is it leisure? Is it a need? Is it a want? And it can help you manage your money more effectively and set spending limits. Why? To avoid overspending. You should review your budget on a regular basis. I would say each month. Find out where your money's going. See if you need to reallocate that money. See if you can cut back in areas and actually increase your savings. Uh, all of that is possible if you're managing your budget. And on that budget sheet that I sent you, the Excel budget sheet, One of the tabs at the bottom is tracking your spending. So you can actually track your spending using that particular budget sheet. It allows you to track how much money you spend each week on groceries. Because if you're going out every week and the amount you spend is different, then you can track your spending. So you know exactly how much money that you are spending. It makes you more aware and conscious of where your money's going. And it can help you support saving habits so that you can grow your money. Adjusting your budget for changes in circumstances might be necessary at times. I remember at one time, Dave and I both was unemployed, so our budget changed quite a bit. So it's really important if something happens, go in and readjust your budget so that it actually is working for you. You know what's going on. And it's okay if we go in and revise that. It's working today, but something happens and it needs to be modified. Savings and investments. A lot of people want to invest and they don't have enough saved. So we're going to talk about that. Before you start trying to invest money, make sure you have enough saved for emergencies. So building an emergency fund. The purpose of that fund is for unexpected events. Your car breaks down. You need new tires. All of those are events that you might not have prepared for. They happen. You didn't expect it. So the goal of saving is to have 3 to 6 months worth of living expenses for a financial buffer. Because the bottom line is if something happens and you lose your job, if you have 3 to 6 months worth of living expenses, you are less stressed about how am I going to do this? How am I going to make this? Because you have a buffer until you find another job. That is the point of that. So you do not want to try to invest before you have 3 to 6 months worth of living expenses. In other words, you can pay your housing, you can pay your PG&E, you can pay your trash. There's enough money in there to pay those expenses for you for 3 to 6 months. You need to make sure that those funds are accessible. In other words, you can get that money quickly, which means it is not in a CD, it's not in a mutual fund. It's usually you can try to find a high paying savings account, but I haven't found one that was even 1% yet. I think it's like 0.3, 0.5. That's probably the highest I've found. But if you put that money in a CD, that money is actually locked in for X amount of time. And it can be, I think at Navy Federal, I've had savings account, CD accounts with them, and they're usually anywhere from a year to a year and a half, and that'll give you like 4% interest. But you can't touch that money because if you do, there's a penalty. So you do want to make sure that those funds, those emergency funds, are not locked into a CD account, a mutual fund, or anywhere where that money has to be held for X amount of times before you can get access to it. Because if you do, then you're going to pay a penalty. So it probably should be in a high yielding savings account. Here's some options that you can look at. Uh, you can try to find high yielding savings account where you can liquidate it easily, but I haven't found any. The highest I've found is like point 0.5, I think 0.5%, not even 1%. But another thing that you can do is CDs, which is certificates of deposit. And like I said, that money has to stay in there anywhere from a year to 2 years or whatever. The more this is what I've noticed, the longer the money is in there, the higher the interest rates. You know why? The bank or the lending institution is using your money for other things too. So it's locked in there so they can use your money. And the longer it's in there, that means the longer they can use your money before they have to pay it back. So, and then you have money markets account, which they combine both high interest rates with limited liquidity, and they can be moderate tolerant. So I would encourage you to get a financial planner, but in order to get a financial planner to work with you, you need to have money saved. You might be able to get a consultation with one. But anywhere in order for them to work with you, most of the time you have to have like 30K or more money so that they can actually work with you to invest the money in a way that they feel would work for you. That's been my experience. I know my kids uh, got my financial planner, and 30K was the amount that she had said in order for her to start working with them. So, introduction, this is going to introduce you to investing basics. When you're dealing with investments, uh, it's actually allocating money to go into stock markets, bonds, mutual funds to grow wealth over time. And you really do need to understand risk. So, there is low risk and there is high risk. The high risk, you can make a lot of money quickly, but you can lose a lot of money quickly too. And low risk is it don't grow as fast, but you don't lose as much if something changes. So you really do need to work with someone that understands finances and financial planning to help you and talk with you to determine how much risk. Because of my age, I do not do high risk investments. All of mine are usually moderate to low. And I know some of the mutual funds that we God actually have a cap under I can't lose all of my money. When I lose 10% of what's in there, it's capped off, but you can't gain that much either. I think it's capped off at 10%. So it's like a balance. You can't grow that much, but you can't lose that much. And so that's sort of like moderate risk. So you can grow, but it's also you can lose some too. So you have to decide what works for you based on your age, based on how much you have and stuff like that. And what I do encourage people to do is diversify. Don't put all your eggs in one basket. Diversify. You might have mutual funds, and then you might have other types of investments. I also have whole life insurance, which is an investment. So it's like you need to diversify and not put all of your money in one particular investment portfolio. Those are my suggestions based on what my financial planner has said, and because I'm not a financial planner, and what I've read. Managing debt and credit. Some common debts are student loans, credit cards, mortgages. These are usually your typical ones. And then prioritize your high interest debt. You need to focus in on paying off debt with high interest rates first. This will reduce the overall interest cost effectively. So it's really important for you to do that. And then prioritize debt payments will also improve your credit scores, which we're going to talk about too. Your credit score is determined about how much money, how much debt you have, how well you pay your bills, and how much money you bring in. It's like debt to income ratio. Debt consolidation benefits. Sometimes you can actually work with organizations that will help you consolidate your debt and reduce the interest rates and pay one payment instead of 4 or 5 different ones. Some people can actually negotiate with the creditor and they become willing to actually lower the interest rates or allow you a lower payment out. I know I've seen this when I worked in corrections. A lot of time, the individuals who had a lot of child support, sometimes they could talk to the creditor and instead of paying $10,000, pay $5,000 up front and get out of that because they want their money. And it's a lot easier to get the 5,000 rather than hold out for 10,000. So sometimes they will actually negotiate that out. And you have to become a good steward over your own finances, which means you need to be disciplined and mindful of the things that you purchase. You're responsible for that. You have to avoid unnecessary borrowing because it comes with interest. So just be aware of that. So understanding your credit scores and reports. Most credit cards will show you your credit score. And this is something that you need to be aware of. Uh, and it's important because your credit score will determine how much interest you pay on a loan. If you have a really good credit score, you'll get a better interest rate. If you have a really poor credit score, your interest rates will be higher. So it's really important to know what your credit scores are and to actually take care of paying your bills on time. Your credit scores actually represent your credit worthiness, and it ranges anywhere from 300 to 850. The higher credit scores reflects responsible credit management, and it can get you better loan and credit card offers. The key factors in getting a credit score comes from your payment history. How well do you pay your bills on time? Amount you owe, your credit history length, new credit, and credit types used. So just know that. So your credit score category 300 to 579 is poor. 850 to 669 is fair. 670 to 739 is good. 740 to 799 is very good. And 800 to 850 is excellent. High credit scores leads to better loans and lower interest rates, and that saves you money over time. One of the things that I really encourage all of you to do if you don't have identity theft insurance, you need to get it. Every time you turn around, you hear about agencies where there's a breach. Somebody has your identity. I don't know, probably in the last 2 or 3 years, I've gotten different places where my credit information, my personal information was stored, called me up and said there was a data breach and your information was taken. So this is what we're going to do. We're going to give you identity monitoring for a year. I take it, although I already have it. So what does it do? It safeguards you from cyber criminals and unauthorized access of your data. There is a dark web where criminals take this information and sell it to others, which includes they can sell your social security number. They can sell all sorts of stuff. I actually have a friend who is still fighting today because of identity theft. And this is going on probably 3 years. She's still fighting to get it resolved. It's not an easy thing to do once your once your identity has been taken. So some of the strategies is changing your password, monitoring your accounts. I encourage you to do that. And if you're budgeting and you have a credit card, you every month you can look at it and see if all those charges are yours. But the thing about identity theft, they can steal your identity and open up a new credit card and it's not coming to your uh it's a new credit card that you have no knowledge of. So, and they actually have it going to their address because they have the credit card along with your identification. So I encourage you strongly to look into getting, it's not, I know I have LifeLock and for monthly minimum, it's like $7.99 a month. I know that Legal Shield has an identity theft program. I know McAfee has one. Find one that works for you and get it because somebody can be using your identity and you have no idea. I know I had a friend, somebody had her social security number. She didn't have a clue until she got ready to use her social security. So you just want to make sure that's just wisdom. That's like having house insurance. You actually may never need it, and if you do need it, it's available. So, like I said earlier, using strong passwords can help with identity protection, monitoring your accounts regularly, and avoid sharing information online. And don't click on suspicious links or emails because it could be a scam. So, planning for the future goals. Long-term financial goals, we need to set them. So we need to be specific and know what the goals are for. Is it for buying a house? Is it for education? Is it for retirement? Why am I saving this money? Be specific on what it is for because how you save it will make a difference. If you're saving it for retirement, you might put some of that money into an IRA, an individualized plan for retirement for yourself, versus putting the money in a CD because you're saving for a house or for educational funding for your kids or yourself. And plan ahead. Most people do not plan for retirement, and when it happens, you end up having to work longer than you anticipated. And do not plan on Social Security because I am here to tell you that in about 6 years, Social Security is going to be impacted negatively if it is not change soon. Nobody wants to work with Social Security because they don't want to deal with it. Now, Social Security will be around, but they're saying, I just listened to a presentation where they're saying if nothing is done in about 6 years, the people who are getting Social Security will have about a $500 deduction because of the way it's not enough money to pay all the people that are now on Social Security. So don't bank on Social Security. So here's some retirement plan options, employee sponsored. If there's a 401, I encourage you to get in there. That money is pre-taxed before they pull that out before the money is taxed. So in other words, you're getting taxed on less so that the amount that they hold on taxes is less. So you want to do that and find out how much they're matching. They used to match dollar for dollar. And I heard somebody say a while back that that has sort of changed. So you do want to do your due diligence to see how much the company is matching or contributing to your 401k. But you can create your own individual retirement plan, your IRAs. You can start those for yourself. Other investment vehicles could be mutual funds, bonds, but like we said earlier, make sure you're diversifying and strengthen your retirement portfolio. Another thing you do want to do is have insurance protection and management. Insurance policies provide financial protection against unexpected losses and damages. I would encourage everyone, even if you are renting, to have renter's insurance just in case something happens and it's like, oh wow, I never expected that. Get renter's insurance, get house insurance, get insurance, get identity theft insurance. It's called protecting yourself from losses. And then do risk management. That's really important to get adequate insurance coverage to eliminate risk and help you become financially stable. So key takeaways from this presentation is budgeting is essential to provide effective money management. Create a saving and investment account. It is suggested that you save 3 to 6 months of expenses, monthly expenses, before you start investing money. Be aware of your credit score. Make sure you pay your bills on time because if you don't and you think it's not impacting you, it is. So make sure you pay your bills on time because not paying your bills on time eventually impacts your credit score. And plan for retirement. Also, look into identity theft protection for yourself. So this is Carolyn, and this is the end of this presentation. I hope and pray that it was beneficial for you. I will also send you a worksheet that you can actually look at and make some of the suggestions, implement some of the suggestions, and I look forward to discussing this video and what's in this video on the last Tuesday of February. Okay, you guys, I'll see you the last Tuesday in February.